Hi believers, this is Amit from Waya team, and I'm here to provide a weekly bite and the road ahead in the markets. This is an important podcast to understand what happened last week and how is the market going to behave forward. Hence, I will go a little slow so you can comprehend better. Indian market closed lower for the week after RBI reduced the expectation of early rate cut at its monetary policy meeting. The Nifty dropped 0.3% while the Bank Nifty fell 0.7%. The broader market, represented by the midcap index, although it outperformed overall in the past week, fell heavily on Friday morning, recovering a bit at the end. Let's first discuss why markets fell. This was much to do with the RBI's MPC meeting outcome. Number one, the governor did not provide any clear indication of rate cuts, which disappointed investors. The RBI clearly stated that it will not lower rates until consumer price inflation falls below its target of 4%. It appears that we will have to wait a little longer to see the rate cuts. Number 2, FY24 CPI inflation was maintained at 5.4%, while the street was expecting some moderation. Number 3, with respect to liquidity in the banking system, banking bankers were expecting that the CRR, which is cash reserve ratio, would be reduced from current 4.5% to increase liquidity in the system. Historically, the CRR level has been around 4%. The RBI did not modify the CRR during this meeting. CRR is the amount of money that the banks are required to retain on deposit with the RBI. A reduction in CRR rates will allow banks to free up funds and expand lending activities. Hence, the Bank Nifty is falling, dragging other indices too. Now, some insights on the bank stocks if you are holding. Except for ICICI Bank, large private banks have not provided considerable returns in the recent years. We believe that the large private banks are unlikely to generate a substantial return. The reason for this is the banks are trading at close to 3 times their book value, which is the upper end of the valuation range for large banks historically. One significant matrix for bank is the net interest margin, also called NIMS, which is nearing its peak for private banks. On personal front, I also exited my long-term holding of ICICI Bank. Although it reported good numbers than the rest of the private bank, it has now reached its peak valuation. We find confidence in PSU banks. While they have closed a valuation gap, the likelihood of re-rating and margin expansion is greater. For investment purposes, we shall prioritize public sector banks above private sector banks. Canara Bank and Central Bank tops the chart. Why they will do good? Because Tier 2 and Tier 3 towns are witnessing deposit growth as well as lending growth, and PSU are much better penetrated in these towns than private banks. Let's understand what happened to PSU companies on Friday. PFC, which is Power Finance Corporation, one of the major PSU, reported 20% YOY growth, which is great, but management comments lowered growth guidance to 15% because liquidity situation remains tight as stated earlier. This created a domino effect to other PSUs, hence many PSU were down over 5%. We believe this will normalize very soon as our current government focus is very high on PSUs, plus they were always undervalued from last 2 decades. Where do we see markets going ahead? A decisive break over 22,150 in Nifty could only fuel the fresh momentum, while 21,200 zone would offer support. It is important to closely observe moves in Bank Nifty as it's the one dragging index, which impacts Nifty too. For Bank Nifty, 47,000 is the crucial resistance and 44,500 is the key support level. Any breach of the given levels will lead to trend upside or downside move in the Bank Nifty index. On the sectoral front, we prefer IT, metal and pharma for long trades. As we move towards rate cut scenario in the US, Indian IT will be the key beneficiary as the spends of the US corporation will rise. Stocks are starting to show actions and we feel it may continue going ahead as valuation are decent even at this point of time. Even if Nifty goes in range bound, we will find good opportunities in stocks based on technicals and fundamentals along with the sector play. Hence, till 2027, we are in good position to make good returns when our economy hits $5 trillion mark. Coming to active wire recommendation, All our recommended stocks have reported a good set of earnings and are respecting key support levels on the day of volatility. We are constantly evaluating all our active calls and shall notify you if there's a change in trend for any of the recommended stocks. Currently, we are not even a little worried on our open calls as we see a great valuation comfort with strong financials. Hence, do not sweat on Waya holdings. Our multi-baggers are doing phenomenal. We are in touch with most of the company's management and so far all looks on the path we projected when we gave the call. We will take profits out soon on couple and invest in new ideas which shows more promising gains in short time. To make money in the market, we need to churn our holdings. Currently, we have shortlisted 5 multi-baggers and will unveil one very soon after a few checks are met. For today's bulletin, that is all. Wishing you a great trading week ahead.